So, did the Bank of England just crash the UK property market and the economy as a whole, with a base rate rise again for the fifth consecutive time of 2.5%? I'm not going to go too much into base rates and the rise of that because I've done a video already on that, but there's a load of factors and arguments saying that we're either heading really fastly towards a recession, already in a recession, or there's arguments, especially for the property market, not so much for the economy as a whole, arguments that there's not going to be a recession. So in this video, we're going to discuss both. We're going to see, are we going to head towards a recession? Well, the arguments for both, not are we, because none of us know. Time in the market always beats time in the market. None of us have got this crystal ball where we can tell exactly what's going to happen. But I'm going to present some of the arguments for both ways, whether the housing market will crash or whether it'll keep on booming. So I'm Harvey, I'm a remote property investor, and if you haven't already, make sure you hit that subscribe button, that bell icon really helps the channel out. But let's get into, are we heading towards recession? Are we in a recession? Is the property market going to crash or is it going to boom? And both arguments both ways. But make sure you stay around to the end, because what I'm going to do as well is I'm going to tell you what you can do to keep yourself time in the market. I say this all the time, and repetition's the mother of all learning, but time in the market is going to beat time in the market. So none of us know for certain. So I'm going to give you some strategies and strong tips at the end, what you can do to navigate this potential recession, or recession that some people believe we're already in. So some of the signs of this happen, we've got the price per earnings rates widening. So the average price in comparison to the average earnings of a property is just getting wider. We've got the pound taking a sharp fall in the forex markets. Wage dramatically behind the growth of the inflation at the moment. And again, I'm not going to talk too much about inflation. We've got inflation that's really high, predicted to be 11%. I've done more videos on inflation here as well. And all this gets stemmed from the cost of living crisis. So are we going to head towards recession? Are we already in a recession? So we're not officially been marked down as an official recession yet. And what is a recession? What is when the GDP in 2 quarters consecutively drops. So we've not got the statistics out at the moment at the time of recording this to tell we're in official recession. But there's a lot of signs that we're heading towards there. Will this recession in the economy crash also the property market? There is a thing in the 1970s called stagflation. And in stagflation times, what it means is you still get inflationary pressures with a GDP drop. So the economy's not doing well, but we've still got inflation going up. And is property going to be protected with that inflation? Obviously, our cost of fuel, our cost of living, energy bills are all going up. But is property going to go up and keep on being inflationary at the moment? It's definitely having an inflationary effect on the market, and it's due to a lack of supply, not enough homes being built, over demand at the moment, and a massive demand of money. So this is one of the arguments as well. So with lending not getting so easy, is it going to now dampen the market? But then the bank done a complete U-turn the other day and took away the stress test and the affordability test, stress testing it 3% above where the base rate is of the person's variables. So there's a lot of contradictory things going on. But in this article from The Guardian, it's saying house price growth outstrips wages 90% of the UK and Wales. In England last year, a home cost on average of 9.1 times earnings, and up from 7.9 times. There's 2 other times this has happened in history when it's gone above 8 times of earnings, and both times the property market has crashed. A direct reaction to the interest rate rises was the pound taking a fall against the dollar as well. But again, this could also prove positive for overseas buyers. While the pound's weak, it sometimes attracts, not sometimes, always attracts usually, overseas buyers, because it becomes cheaper for them to translate their money into English and then buy properties at a discount just from the exchange rates. In this Bloomberg article, it says that interest rates are rising and economists expect even more increases. Buyer inquiries fell in May after gaining for the 8th consecutive month. So the price was going up, but buyer inquiries went down, and according to the chartered surveyors. And an index of house builders' share have fallen more than 1/3 since April 2021. Through both London and the UK, house prices being hit, even despite of UK house prices hitting a record. So again, these are predicting a softening or a fall in property prices. But the thing that's on the favour of property is the undersupply of homes. We've got a woefully shortage of homes and there's a massive pressure on that. But can this sustain? The Telegraph warned that the gulf between wages and house price risk causing another financial crisis. And it is feared that the increasing strain on household finances caused by raising costs will divert virtual spending from the economy, and it will basically have an impact on there. So basically, if people can't afford so much because the cost of living is going up so much, their mortgage is going up so much, it's gonna have an impact on the economy and people's like pleasure spending, going out to restaurants, going out to bars, spending on things like clothes and cars. It's gonna have a knock-on impact. So we've definitely got signs that the market could drop and signs that the market could still go out in the property element. I believe we're going to hit a recession. It's only my views. None of us got a magic crystal ball, as I said at the start. But in my views, I feel we're hit a recession. But I'm not sure I feel the property market is more vulnerable to slow down and maybe have a slight correction here and there than it is to actually have a full-on crash. I think the banks have been lending responsible. I think this announcement of releasing of the stress test is more of a sentiment thing, because what the banks are trying to do is they're trying to slow down inflation without completely crashing the markets. And part of the market direction is based on sentiment, how people feel. And if the rates are going up and cost of living is going up and it's all in the news, people panic. And it has a much bigger impact than actually a 2.5% increase in your rates. So what I believe this move is, by saying we remove that stress test, is basically to stop like the panic so much. I don't think they're going to majorly over borrow and over leverage. Banks are in a bigger, stronger position than they was in the last crisis. The last crisis was a mortgage crisis, and the banks was out of money because they loaned irresponsibly. They was giving out 110% mortgages to people with a ninja mortgage, no earnings, no income, no assets sort of mortgages, no job mortgages. You just sign a piece of paper to say you can afford it, and I was giving these out. You can't get that sort of lending at the moment. So lending is much more responsible. Banks, in my experience at the moment, still got a decent appetite towards lending. So the supply and demand of the money is still pretty good at the moment, although they are getting a lot more cautious. I think we're going to see a lot more down valuations, which will slow the market regardless of what happens. So yeah, it's definitely an interesting time. And as I promised at the start, time in the market is going to beat time in the market. So what do you do as property investors to stay time in the market? It's about building an all-weather portfolio. So let me just show you. Look, on this board here, I'm going to take you down here on this board to my all-weather portfolio and how I structure this and what you can do and what you can think about in your journey. This goes back to the property delta matrix. We won't go into too much of this, but you want to build out a solid foundation of single-let properties. This is the stuff that ride you up and down through any market. So you want stuff that can handle rate rises. You want stuff that can, if people lose their jobs, go on to benefits, can be covered by benefits. And I'll show you my all-weather portfolio. When you go further up this, commercial conversions are okay, but not if you're developing them in this market, if you've not got backup or be able to raise private funds, because banks can pull out of products if they get uncomfortable in the market, especially with commercial lending. And SAs and things like that can have shocks from, like we see in COVID. And at the moment, more people are traveling again, and we're going to have such a good year with not so much of the staycation boom. So there is different things that affect these up higher. This buy to let stuff, it's not sexy, it's not get you rich quick, but it's solid stuff that will ride you out in any storm. So have a quick look at the all-weather portfolio. So all-weather portfolio is having a diverse portfolio of HMOs, SAs, commercial conversion, buy-to-lets. And these different sections of buy-to-lets are the different style buy-to-lets. So these are more higher-end buy-to-lets, these are the more lower-end buy-to-lets. You don't want a full portfolio or too many lower-end or higher-end, and I'll explain why. So this section of buy-to-lets, this is actually my portfolio. This section of buy-to-lets are your vanilla buy-to-lets. In my area, they rent for about $550 a month. Housing benefits is £500 a month. So if somebody loses their job, they're protected by that. The average mortgage on these are about $150 to £200 a month. As you can see, if rates double again, I've got quite a bit of protection on that. So this is the really protection part. So if I have lower end tenants that give me problems, they yield more, but the problems you get with that get balanced out by that and protected by that. The higher end stuff, so like in my area, this is like £700-800 a month. The yields on these are lower, so the interest rates double, you get in trouble a lot quicker. But also, if people lose their job, benefits only pay £500 a month still. So basically, you've got like a £300 potential shortfall, and you've got 20 of those. That can get you into trouble really quickly. I've got some commercial conversion. Commercial conversions are great once they're developed worked out, but if you're halfway through a development and the bank change their appetite and recall, you can get in trouble. Similar again with SAs is up and down. It's not consistent income. And if people are getting tightened on their cost of living and their spending and losing jobs, are so many people going to staycation? It's something that could be affected, but worth having in there because of the cash flow. And then HMOs, again, there should be a line through here for HMOs. I've got some social housing HMOs and I've got some normal HMOs. The normal HMOs are much more vulnerable. I'm just doing a high-end one at the moment, but the reason I'm doing a high-end one is because I've got protection from all this other part of my portfolio. But social housing ones as well give me protection because they're guaranteed rents for like 5-10 years. So we've got one with Mears, for example, giving us a 10-year guaranteed rent with no bills, no maintenance. So great protection and hedge against some of these more vulnerable strategies. So stick in your predictions in the comments what you think the market's going to do. Stick in the comments what you're going to do. Sitting on your hands is not an option. Inflation is eroding your money. Property invested correctly and with risk management is a hedge against inflation. So pick what strategy you should be doing depending on where you are in your journey. Put it in the comments, let me know. Please, if you've not already, subscribe, hit the bell icon, share this out. My mission and my wife's living my terms. My mission is to help as many people live in their terms. So if you can share this really, really helps. And remember, if you don't evolve your ideas, you never live on your own terms. So evolve your ideas, live on your own terms. Have a fantastic day.